Hey folks, thanks for joining. This is Nick Cannon with American Portfolios, and this short webinar is going to teach you how to structure and protect your Verizon 401k. So I'm going to reveal a little known strategy that Verizon has allowed you to use in your 401k to help you protect and grow your retirement plans. And you're going to kind of see how to do that. 20-25 minutes, we'll get through it quickly, but this is very important information if you're concerned about your retirement, your 401k, and making sure you're in the right place. Before we get into that, we have to do disclosures. So basically, everything that I'm talking about here should not be construed as investing recommendations. Investing provides a lot of risk, and you have to make sure that you do your homework. Possible loss of principal. So just basically, make sure you understand what you're doing before you do it, and this is for information purposes only. So who is this webinar for? So it's for Verizon professionals who've spent the last 5, 10, 15 plus years building your 401k. Individuals who are looking to ensure that you're doing what you can to protect the assets that you've worked so hard to grow. And folks who are nervous about the market correction that could severely impact their account value. So if you've built up this nice nest egg, and now you're worried, if a market correction could take that away, or at least portion of it away, and then you have to rebuild what you've worked so hard to build. So in the next few minutes, I'm going to do a few things for you. So the first one is to discover how to determine your risk appetite. This is very important when constructing a portfolio. So understanding what your risk appetite is and how to structure your 401k based on that risk profile. So you need to know what your risk appetite is, and then how to structure your portfolio based on that profile. And then I'll show you the last key that we're going to talk about is I'm going to show you what Verizon does to allow you to protect a portion of your 401k. You can protect it 100%, typically 100%. And so you protect the downside and you still participate in the upside moves of the market should they happen. And so that's something that, please stick around to the end, and we'll talk about that as the last key. We'll also learn what sequence of return risks are and how it could crush your retirement account, and how executing a strategy that Verizon allows you to do within your 401k will help you protect your profits while maintaining, probability of higher returns. So that's my promise to you. So I'm going to show you 5 keys that you must implement in order to ensure you put yourself in the best possible position to retire comfortably. And so, we have to make sure that you're in the right place, and this is something that's applicable to your situation. So, if this sounds like you're putting money in your 401k, but if the market crashes, you're in trouble, and you're going to have to make up that money. If you know people with defined pensions, which is almost unheard of nowadays, they're living a good retirement, and you have no idea how you're going to be able to create that type of situation for you and your family. You're in the right place. If you know family members and friends who have experienced significant market loss, whether it be in the stock market or other investments, and have had a hard time recovering, and some of them have to work in retirement and not choose to work in retirement. Or if you have no idea if the money that you're putting in your 401k is in the right investments, that's a key one. So people just throw money into their 401k and just kind of hope for the best. If that's you, you're in the right place. And at the very end, if you're secretly terrified that you're going to have to work, that's what I said previously. But if you're worried you're going to have to work the rest of your life because the money you saved was in the wrong place or vulnerable to severe market crash, stick around to the end. Again, we're going to try to make this relatively quick. The real problem with all of those scenarios is that you don't know the keys to structure your portfolio, and you don't know the benefits that Verizon has in place for you. So once you implement the keys that I'm going to share with you, you'll have the peace of mind that you have the right risk profile for your investment needs. You'll be confident that the investments you're in are the right ones and give you the highest probability of success. You'll use the ability that Verizon gives you to protect a portion of your 401k from market risk. You'll understand what the sequence of return risk and how to guard against it. And again, you'll have the peace of mind that you're on the right track to the retirement that you deserve. So let's quickly talk about who I am. My name is Nick Cannon. I'm with American Portfolios. I'm a financial professional who focuses on retirement planning and protection, specifically for Verizon employees. I have a Series 7 and 66, as well as life health licenses in 13 states. I'm a member of a team that manages over $1 billion in assets, that has experience for over 30 years. Devoted husband and father is the most important bullet point on this slide. Wonderful 2 little girls and a wonderful wife. Family is everything and my priority. And I'm happy to be in that situation and be here with you today. All right, so let's talk about the keys. So there are 5 keys that you must implement in order to ensure that you put yourself in the best possible position to retire comfortably. I'm going to walk through that in this session. I'm not about a lot of fluff. I like to get direct. I'm sure you guys have been on, hundreds, tens or hundreds of webinars that just do a lot of fluff and a lot of preamble and setup and all that. I don't want to do that. I want to get to the point. I want to give you the information, and I want to give you the opportunity to act on it. So key number 1 is understanding your risk profile. So, the majority of Verizon employees, as I mentioned before, just have money taken out of their accounts and then hope that they're in the right place. So you put it in a target date fund, or you just put it in your 401k and hope for the best. You don't really know how risky it is or how exposed you are to market risks, or if you can actually stomach the risk. And so it's important to know your risk profile. And so on the next slide, I'm going to show you a typical risk profile questionnaire score. And there's multiple ways that you can do risk profiles. There's a lot of different ways. I'm going to show you 2 different ways that you can do it. But the important thing is that you have a risk profile. So everybody that joins the webinar, you're going to get a link to this risk profile questionnaire, so you know what your score is and you kind of understand where you're at. So this is the scoring key. So basically, for the link that I'm going to send you for the survey, this is basically if you score between 0 and 20, you're conservative. If you're 21 to 40, you're moderately conservative. So you basically are looking to build and preserve assets with a need for current income. Portfolios characterized by majority allocation of fixed income, which there needs to be some fixed income alternatives right now with the market environment that we're in, and we'll talk about that as well. And then it goes up from there. So you see, if you're 81 to 100, you are aggressive. So you basically are willing to take on a lot of risk, but you're willing to get a lot of reward for it. And so there's a way to structure a portfolio that way as well. The other way to look at this is from a timeline perspective. So if you look on this timeline, so this is like 2008 to 9, and if you look at what the market did, how much of this can you really stomach? And so there's a software that I use that'll show you. It'll hit start, and then it'll start down the timeline and show you, based on the amount of money that you have, what is your appetite for risk. So how much can you lose and still sleep at night? And so that's another way to do your risk profile. Again, there's multiple different ways, but that's one one of the ones to use as well. So understanding your risk means that you understand kind of different types of risk. So there's risk tolerance, which is your willingness to take risk, which may potentially impact the overall size of the reward. So the more risk you take, the more reward you get. And then risk capacity, which is the amount of risk you can afford to take. So it's based on your income, your age, and the time horizon. Those are the factors that normally influence your capacity. And so if you're 5 years to retirement, your risk capacity is going to be a lot lower than if you have 30 years to retirement. And so that's something to take into consideration. So that's key number 1. So understanding your risk profile. Key number 2 is understand which investments are historically more risky. And so, this may be, repetitive or review for some people, but it's important to go over so you understand kind of which investments are more historically more risky than others. So the most common types of asset classes are equities, bonds, and cash. Now, there's a lot of different wrappers. There's ETFs, there's mutual funds, there's SMAs, you do individual, individual investments, there's alternatives, there's, a lot of different ways, there's, real estate and all these different ways that you can invest in real estate. You got REITs and non-trade. There's a plethora of asset classes and ways you can invest your money. But we're going to talk about the most common asset classes, and especially within your 401k, these are generally the ones that you have access to. You don't have access to the alternatives and some of the other, more sophisticated investments. And so when you look at stocks and bonds, stocks versus bonds, and there's a lot of words on this screen. I'm not going to go through each individual, column here, but basically the long and short of it is stocks, you're a part owner of the company. So when you buy a share of stock, that gives you part ownership of that company. There's a couple of different types of stock: common stock, preferred stock, so on and so forth. So there's a lot of different ways to structure stocks, but basically you own a portion of the company. Bonds is a debt instrument. So basically the company is a debtor to you. So you're lending them money, they're giving you a bond, they pay you back at a certain amount of time for a fixed rate, generally a fixed rate based on interest rates and the way things fluctuate. So they'll perform better or worse than coupon rates. So it's there's a lot of risks from interest rates and inflation with bonds. Market risk is on the stock side. So market risk, business risk. So if the company tanks, then the stock's going to get impacted. If the market tanks, then stock may be impacted. Now it's important to know that there's a difference between the actual company performance and the stock performance. So obviously they correlate, but generally speaking, the valuation of the company doesn't always line up with the valuation of the stock. And so, AMC, GME is a good example recently of where this took place. So the valuation of the company, like the actual fundamental value of the company, was significantly lower than the price of the stock. But because of the volume that went into the market and purchased the stock, it inflated the price. And so we have a lot of those risks going on right now where, stock market valuations are a little bit disjointed from the valuations of the actual company. So those are risks to take into consideration. Bonds, the same thing. There's a lot of bond risk going on. But when you look at kind of the risk-return relationship, this is generally speaking, where we're at historically. Now, right now, I would argue that bonds are, almost as risky as stocks, depending on what bond you're buying. But generally, historically speaking, this is what we're talking about from a risk profile standpoint. And then again, there's a lot of different types of bonds and stocks, and this kind of gives you an idea of which ones are more risky. So the most risky asset classes are speculative and emerging market stocks, junk bonds, which are lower rated bonds that gives higher yields, options and futures contracts, which if you have any interest in any of that stuff, I'm happy to walk you through, how they work and what different strategies you can use to invest in those. A little lower risky is blue chip stocks, real estate and royalty trusts. Then you go to corporates, government and municipal bonds and fixed interest securities. And then you go into savings account CDs, treasury securities and cash. So, there's pros and cons to each one of these asset classes, but basically, historically, that's the risk profile for the specific asset classes. So, now that you understand, which assets are more or less risky, now it's important to structure your 401k based on your risk profile and your age. So you have your risk profile, you have your age, and obviously income comes into play here. But generally speaking, you use the rule of 100. So basically you take 100 and you subtract your age from it, and then that's the amount that you generally should put in more aggressive asset classes, specifically stocks. And so, if you're 25 and you do, subtract that from 100, you get 75, so 75% of your money should be in some form of stock. If you're 75, that's reversed, so 25% should be in stock. And so if you use the rule of 100, this is the formula to take, once you're creating your portfolio. So when you look at your Verizon 401k, step one is, take your risk score, apply it to a risk category. So you're either conservative, balanced, growth, aggressive, whatever category you're in. So exactly kind of what type of risk you want to take. And then number two, you take the rule of 100, and this is very simple. So this is not, there's a lot more sophisticated ways to do this, but if you're just looking at your 401k and you want a ground foundation, this is a way to do it. Take your risk score, apply it to a risk category, take the rule of 100, subtract your age, put that amount in equities, the rest in more conservative assets. And then number three, make sure you're diversified. So you don't want to be concentrated too much in like U.S. equities, or you want to diversify things so that you have it spread out over time. This is honestly where talking to a financial professional comes into play. So you can walk through this with somebody that'll actually give your specific situation a look and make sure that you understand kind of what you're doing. So that's key number three. So that's the formula to create your portfolio. So now we're going to pivot a little bit and talk about the sequence of returns. And so when you have this thing created, you have to understand kind of what you're vulnerable to, and if you do take a hit, what that would take to come back from it. So, the two slides that I created here for sequence of returns are a little bit busy, but I want to kind of give you a high-level understanding of what it is and how it works. So sequence of return risk, or sequence risk, is the risk that an investor will experience negative portfolio returns very late in their working lives and or early in retirement. And this risk is a significant threat because retirees have little time to make up for losses, and that compounds simultaneous drawdowns of income distribution. So basically the long and short of it, and I'll explain this. So the sequence of return risk basically says if you have $100 and you lose 50% of your money, you now have $50. So in order to make that up, you need 100% return to get back flat. And so, that's a big risk. So when you compound that within retirement, you have the need for income. So let's just take, you have $100,000 and you're taking 4% out a year, which is generally historically the number, but I'm more comfortable with 2 to 3%. So let's just say 4%. So $100,000, you take 4% out a year. So that 4% comes out regardless. So that's reducing your capital. Now you need to make a return in the market of at least 4% or 5% to give you, cushion for the future. So you need to have that income coming in, you need that return. Now what if there's a 10% hit on your portfolio for a year? So now you went from $100,000 to down to $90,000 plus the 4% withdrawal. So now you have a 14% deficit that you have to make up, plus the 4% next year, plus that additional runway. So the sequence of return risk could be a killer when it comes to retirement income. Just a quick example, and I'll go to this slide to kind of show you the numbers of what happens when you have the sequence of return risk come into play and what happens when you don't. I'm not going to go through this in detail, but just basically, if you can protect your income initially in retirement, you're much better off at the end. So I'm going to tell you a quick personal story. My father had a 401k that he had built up. He worked for the same company for 43 years, and he was going to retire. And then 2008 hit, and it took away 40% of his 401k, and he had to wait another 8 years before he was able to retire and made up that deficit, plus put him in a good position to retire. So that's how impactful this can be. So you have to understand how exposed you are to the markets and what the risks are. And again, that's where financial professionals come into play. That's where you can get into a discussion with somebody that can see, okay, here's your portfolio, here's how exposed it is, here's the risks that you have going into today's market environment and how to protect it and how to structure it accordingly. So that's key number 4. So number 5 is, we talked about the formula on how to structure your portfolio. We talked about the sequence of return risks. Now, it's important to know that Verizon allows you to remove those risks in certain ways, and I'm going to explain what those are. But basically, you could remove the sequence of return risk from your portfolio. And I put this on here at Warren Buffett, so he's probably the best long-term value investor ever. His rule number 1 is never lose money. His rule number 2 is never forget rule number 1. And so, Verizon allows you as an employee to do what's called a non-hardship in-service distribution. So you could take a portion of your 401k, move it to another tax-deferred account, so it'll go from a 401k to a traditional IRA, invest it however you want. There's no tax consequences, there's no fees to do that. I think there might be a $25 transfer fee, but there's no asset management fees or anything like that. So they allow you to do that. So you can put that money anywhere. So you can structure it in, there's different, investments with what they call portfolio insurance, which gives you stop losses if the market goes down a certain amount. And then there's what I'm going to talk about next, which is called, they're called equity indexed annuities. And so, you basically can take the profits that you've made for the last 10 years and protect those profits. Or you can look at the bond allocation that you have in your portfolio and realize bonds aren't really attractive right now. Let's take that money and put it into a bond alternative, protect it 100%, and still allow your money to grow. So, the important thing here is, working with an advisor or talking, it doesn't have to be me or my team, but it's just whoever you trust, whoever you can talk to determine what type of principal protection that you need in your portfolio. So it could be, again, it could be an equity index annuity, which is what I'm going to talk about. And I'm going to explain kind of differences with the annuities. There's been some, bad press when it comes to variable annuities. But generally speaking, this is a good way to do it. They've come a long way in the last 20 years. You could do an annuity, or you can do another principal protected investment that gives you downside protection. It doesn't matter, just so you put it in a place where it's more protection and you still have some upside participation. So these types of investments that I'm going to talk about next are, again, you can get partial principal protection or 100% principal protection. You have a lot of different investment options. In today's environment, the crediting is really good, so you can get over 100% crediting on indexes. You can do ETFs, mutual funds, whatever. Understanding participation rates and spreads, and fees. So a lot of these have zero fees. So that's something, even in your 401k, if you look at the actual fees in your 401k, you're paying, 2-3% on your money with all, record keeping fees and, advisory fees and all that stuff. They're in there. So, these strategies that I'm going to go over can have zero fees. I mean, there's a lot of different strategies, but there's some that you can do 100% principal protection and zero fees. So let's talk about equity index annuities. But first, before I do that, I want to go over kind of the different types of annuities. So number one, there's variable annuities. Historically speaking, these variable annuities give you some benefits, but they're really high in fees. They're not generally principal protected. They're exposed to the markets, but they give you tax defer. I generally use variable annuities for non-qualified accounts or non-retirement accounts, if it makes sense. But that's variable annuities. Then you have fixed annuities, which just give a rate of return. So you put the money in, it's a specific rate of return for a specific amount of time. And then you have equity index annuities, which in my opinion is the best of all worlds. So you have principal protection, you have low or no fees, and you have participation in the market up move. So if the market goes up, you make money. If the market goes down, you don't lose anything. So it's really great to do this. And this is an example. This next slide is an example of the last 10 years. So the most recent 10-year period, if you put $100,000 in, what you would have, and you could see, here, the most recent period, you put 100,000 in 10 years, you have 246, 5.31 rate of return. The highest 10-year period is 6% return, you get 272, and the lowest 10-year period is 3.78. You still almost doubled your money in 10 years. So that's really kind of an idea, and again, illustration purposes only. Nobody has a crystal ball, but at the very least, you don't lose money and you keep up with the rate of inflation. So there's some of these that have fixed buckets where you get a guaranteed percentage every year that'll help keep up with inflation. So that's in a nutshell. So you could take you create a risk profile, you have a formula on how to structure your portfolio. You understand sequence of returns and how to mitigate sequence or remove sequence of returns from your portfolio, and then you structure your profile accordingly. So now, this is what I promised you today. So discovering your risk appetite, understand how that works, how to structure your 401k, how Verizon allows you to protect your 401k, learn what sequence of return risk is, and how to remove sequence of returns from your portfolio. So now you have a choice. You've gone 22 minutes. You've gone through this webinar. You kind of understand the purpose of it. You can go back and do what you did. Just keep throwing money in a 401k and hope for the best, and not really understanding how it's structured or how it's how it's exposed to the market. Or you can reach out to my team. Or again, this is for information purposes only. I'm offering my services if you need them. If you have somebody that you trust, please go talk to them. But we're here. We've set aside the next 48 hours or so. I have open spots on my calendar for I actually keep open spots on my calendar pretty much every week for this webinar. So when people want to talk to me and my team, I try to get to them, but if I can't get to them, I pass it on to my team. And understanding how you can apply this strategy to you if you even need it. So some people have portfolios that are structured and they're structured well, and you don't need to take advantage of reallocating assets. But if your concerns are there, if this makes sense to you, it resonates, we're here to talk to you. In the session that we're going to have with you, it's going to, the initial session's 30 minutes tops. We'll work with you to determine your current situation and customize your plan. And honestly, it's we've seen everything. There's no scenario that we have that we can be exposed to that we haven't seen. There's no cost to this. We'll just have a discussion, and if we want to work together and it makes sense, we'll do that. If not, then we won't. And before I let you go, this is who it's for. So if you're committed to protecting your profits that you've made the last 10 years, concerned about your portfolio, that your portfolio isn't invested correctly, and worried that you outlive your savings. One of the things I mentioned with equity index annuities is there's a living benefit, which means that if your account goes to zero, so you're taking income every single year, if your account goes to zero, you still get your paycheck every single month. Like that's your pension. You're defining your pension for yourself. So that's a key point. We're doing, honestly, I'm not going to go through this slide a lot, but basically I'm doing this because I was frustrated in seeing people, kind of blindly throwing their money into their 401ks and really not understanding how to structure things. And so, here's the link. The link's going to be in the comments below. But if you want to set up some time with me and my team, this is a Calendly link. Set up time. We'll gladly meet with you. There's no obligation. I'm not a high pressure sales guy. I don't twist arms. I just want to help people. I want to help you as Verizon employees make sure you're protected and you understand how to protect your 401k. And so, I'm very thankful that you spent the time with me here. 25 minutes, went through it efficiently. Any questions, my contact information is going to be there as well. Please email me, call me, or set up a meeting, and we'll go from there. Thanks, everybody. Thank you for your time.